In this video, we are going to know more about startups and how they raise funds. We will focus on investments that are done on equity-based principles. The main trait for this sort of funding is that the investor becomes a shareholder in the startup. In other words, the investor becomes a co-owner in the startup or the business. It means that the investor shares with entrepreneurs on the profit and on the loss. Here are the channels that startups use to raise funds for their businesses. 1. Angel investors. Angel investors are people or organizations that provide money to potential enterprises in their initial phases. Angel investors can coach your company for good equity to compensate for the risk, often up to 30%. They assess the product's marketability along with the technical team and the first adopters. It's not simple for a startup to attract an angel investor and demonstrate the potential of the firm. It's important to know that before reaching out to angel investors in your industry, you must create a killer pitch, an impeccable business plan, and a proof of concept. 2. Venture capital firms. Venture capitals are professionally managed funds. These firms invest in scalable and high-potential enterprises. Their knowledge and guidance can help small firms that already exhibit good key performance indicators, or KPIs in short. However, VC investors typically intend to get their money back in 3 to 5 years. Therefore, they wouldn't be interested in businesses that require more time to reach the market. VCs seek out businesses with a solid strategy and a committed team. If you don't feel at ease with that, it might not be a great option for the startup to get funded. 3. Crowdfunding. Crowdfunding is a way of raising money to finance projects and businesses. It enables fundraisers to collect money from many people via online platforms. Crowdfunding is a revolutionary concept, unlike VCs and angel investors, who are usually accredited investors with high or ultra-high wealth. Investors from all income level classes can fund startups through these sort of platforms. Startups and small businesses most frequently use crowdfunding as a means of obtaining alternative capital. It's a creative way of fundraising for new projects, businesses, or ideas. Crowdfunding can also be used as a channel for creating a network of support for the startup's product service. Startups can access new customers and acquire vital industry information by using the strength of the online community. Crowdfunding platforms are digital web applications that facilitate communication between fundraisers and the public. Through these platforms, financial pledges can be made and collected. If the fundraising campaign is successful, crowdfunding platforms typically charge fundraisers a fee. Platforms for crowdfunding are required to offer a safe and simple service in exchange. The funding strategy that's in use by major platforms is all or nothing. This means that if the startup meets the target fund, then the startup will receive the money. Otherwise, investors will receive their money back with no repercussions or financial loss. With that said, we come to the end of our video. If you liked it, press like, share with your network, and don't forget to subscribe if you're interested in future content. This will help us to grow and provide more professional content that helps you to be a better opportunity hunter and super smart investor. Oh, don't also forget to activate the bell icon so you get notified with our new content.